get in some insight on the market. What is it that you as a retail investor should be doing? How is it that you should be reading into the developments around the globe after the few days of a shake-off that we had in the Mag 7 and now Nvidia pulling up through, and still a big question mark on what the Fed is going to do. And at the same time, with the earnings now behind us, you've got the budget coming up in just a few months from now. And while the support from the DIIs as well as the mutual funds continues, the FIIs are still sort of eluding our markets. Let's talk about all of this. We've got Nilesh Shah, MD at Kotak AMC, joining in to talk about that. Nilesh, hi, good morning. Great to have you on ET Now today. Nilesh, amidst this global reset which is at play, how should Indian investors be holding up, and what is it that they should be doing?
So thank you, Aisha, for having me over here. Undoubtedly, yesterday night, when Nvidia declared result, it made a turnaround. Results were above expectation. I was just looking at one of the line which talked about how their receivables have gone up. This year, their sales are up about $18 billion, and their receivables are up about $10.5 billion. So clearly, there will be some skeptics who will continue to believe that AI could result into lesser return for the investors. We'll have to see how things shape up. As of today, in India, in listed space, we have very limited AI investment opportunity, or dare we say, no AI investment opportunity. How will investors position India whenever AI-related trades start unwinding? Will India get flows as anti-AI market, or will it fall in tandem with what happens globally? When markets are rising globally, we haven't participated. Could that be a reason for decoupling? My answer is that temporarily we may fall in tandem with global markets, but then our local fundamentals will prevail. The anti-AI trade could be a good positioning, and we could see flows coming from global investors if over coming quarters our earnings growth goes into double digit, which we are hopeful.
Nilesh, amidst this, fast-changing world and adopting to AI and, pretty much all investment thesis in the world revolving around that, I wanted to understand whether India will just remain a tactical play in that sense, or do you think there could be a meaningful comeback of money finding its way into India?
I think over a period of time, we will remain meaningful play. Today, we are fourth largest economy globally, fifth largest manufacturer globally, and more importantly, on an incremental basis, we deliver about 8 to 9% of incremental global GDP growth. If we look at it on a purchasing power parity basis, that number goes upwards of 18%. I don't think so investors will be able to exclude a country which is global engine of the growth train. Of course, there are other markets like US and China, and we'll have to deliver on earnings growth. Our return on equity remains good, and valuations after 1.25 years of underperformance have corrected. Yes, when a trend like AI emerges, India having limited or no presence will be missed out undoubtedly. But hopefully, once this trend starts reversing, there could be some flows coming for domestic fundamentals also.
Nilesh, how do you see the entire global setup amidst all this? You have a Fed which may go for a pause in December. At the same time, the macroeconomic numbers for us domestically, there is an expectation that there could be a 25 bips or maybe a 50 bips cut here in India. How do you see that macro playing out for India?
On the global side, Sajid, we have to watch out for two things. One, will there be dollar devaluation, dollar debasement? Trump's policies is creating uncertainty for global investors. On one side, the pressure is pulling money into US markets. On the other side, fear could pull money out of US market. We have seen dollar depreciating 10 to 12%, and benefit of that is visible in gold, silver, and other commodities, where thanks to dollar depreciation and central banks' desire of diversifying their reserve, we have seen gold, silver, and other precious metal prices moving up. So first focus will be on dollar devaluation, debasement, and how does central bank behave. The second challenge will be the independence of institutions. US Fed was an independent institution, and today we are seeing how its independence is getting compromised. When institutions falter, undoubtedly investors lose confidence. How does this play out going forward? Will that result into capital outflows from America? With dollar weakening and institutions faltering, investors may pull money out of America. Global investors own about $30 trillion in US assets. Even a small fraction comes out, it will flow towards emerging market, including China and India. So we'll have to look at how institutions falter along with dollar debasement to figure out what kind of flows can come towards emerging market. The third and the final point is US tariff. Today, they are unjustly levied on India. We are not the largest importer of oil or energy from Russia. China and European Union are far more. America has given specific exemption to countries like Poland, which import 90% of their energy requirement from Russia. And yet, America has singled out India for 25% additional tariff. Now, if this tariff goes away, undoubtedly our economy benefits and we will see growth probably inching up a little bit. If this tariff continues to stay, then there will be some impact and hence probably push from RBI to provide liquidity and cut interest rates to support growth. So how does US tariff deal moves forward will be another factor to watch out from geopolitical point of view. Amongst all the global uncertainty on which we don't have control, we should focus on reforms in India. And we are seeing overdrive over there. In the pre-budget consultations, focuses on reforms. At the regulator, RBI, SEBI, IRDAI, PFRDA, focuses on reform. There is focus on improving ease of doing business, focus on encouraging Atmanirbharta in critical technologies. Put together, I believe the domestic growth could surprise on the upside with all the reforms action taking place. And if tariff deal materializes, that will be Sone pe Suhaga.
Nilesh, hi, good morning. Nilesh, will the outperformance materialize? How quickly will it materialize is what I'm trying to get to. H2 FY26, or are we looking at FY27 as being the year of outperformance versus expectations in terms of India growth?
I think GDP growth will start outperforming. It has been outperforming for some time. Most analysts, including IMF, World Bank, continues to revise their target upwards. So GDP upside is coming. But for stock market, GDP alone is not sufficient. What matters is earnings growth. And for last 6 quarters till September 25, earnings growth has been in single digit. Sometimes high single digit, sometimes mid single digit, but not crossing double digit. For markets which were priced at premium to global peers, for markets which were expecting double-digit earnings growth, this was unexpected surprise. And hence markets have consolidated stroke corrected. Now it is almost at all-time high level because there is hope that with the GST cuts, economy will get supported and corporate earnings growth will come back. If you remove the 3 oil marketing companies' profitability, the overall earnings growth for September 25 quarter continues to remain in single digit. But with the festival spending, expectation is that going forward, earnings growth should return into double digit. Market probably would like to see some consistency in performance. And hence, I will say, from a market point of view, FY27 has a better chance of outperformance rather than reminder of the FY26.
But Nilesh, what would the strategy from the government's end be like? Because, there seems to be a very clear focus on propelling and, moving up domestic consumption. You saw that with the income tax cuts, GST rationalization, and then the bazooka from the RBI. Now with the budget just a few months away, do you think that focus is going to continue? Will it be more of the same?
Aisha, as government, they have multiple roles to do. For example, one thing is to find the alternate markets. India runs the second largest goods trade deficit in the world at $250 billion. America is the largest, but we are the second largest. We need to leverage that to find access for our exports. Today, gem and jewelry, textiles, aquaculture, handicraft all have been impacted by unjust US tariff. But there will be demand for these products in rest of the world also. And when we are running second largest goods deficit in the world, we should be able to open the access to other markets. Similarly, we have one of the largest domestic access. Many foreign companies can't operate in China, like Google, Amazon, Facebook, X, Meta. Today, they can all freely operate in India. We need to leverage our domestic market to again open up alternate exports market so that the adverse impact of unjust American tariff is reduced. Second, obviously, government has to do more of the same. On ease of doing business, several steps have been taken, but still the journey has to continue. There is a need to add Inspector Raj, which is impacting our small and medium enterprises. It is even impacting many of the listed companies. Today also you talked about one company receiving, notices. Now, how many of these cases are real? How many of these cases are just for the sake of achieving your target? We don't know. So undoubtedly, government has to do more of the same and also do more of the new.
Okay. Nilesh, we'll leave it at that. Thank you for coming in and speaking to us, giving us that perspective on a day like this. Very, very important. We're very close to record highs, of course, on the index. And as we get there,